They've dealt with no yield on gold, but they've never owned a lot of gold because there's no yield. So they do prefer it. And, that's why I think when the ETH ETF has yield, which will come, it'll be more attractive to them. How do you get the Bitcoin ETF? Well, it'll be the same as the safest yield will be this kind of borrowing fees for borrowing it. And if it's run by large institutions, you've got some backstop protection. All ETFs have some sort of yield from borrowing that's often taken by the asset manager. I just don't like it because the capital gains is so big. We're not trying to eke out an extra few percent here.
Hey guys, welcome to Everyday Finance. Similarities are being drawn between the current macroeconomic environment and the conditions that were responsible for the historic bull run in the cryptocurrency market in 2017. The aggressive tariff policies implemented by President Donald Trump at the time set off a chain reaction that affected economies all over the world. It was at the same time that China, which was experiencing economic headwinds, started injecting massive amounts of liquidity into the global economy that his administration made a pivot on the United States dollar, initially stating that it was too strong. This led to a weaker greenback. This dual effect of increased liquidity and a declining dollar contributed to the creation of a favorable environment for Bitcoin to flourish, which resulted in one of the most dramatic surges in the history of cryptocurrency. Raoul Pal, the current CEO of Real Vision and a former executive at Goldman Sachs, observes a pattern that is strikingly similar to the one that is unfolding today. With Trump once again in the White House, early signs of liquidity injection reappearing, and the global financial system on edge, it is possible that the stage is set for a breakout that is even more powerful and has the potential to occur even more quickly. Pal and other market veterans are of the opinion that the structural signals that were present in 2017 are making a comeback. However, this time they are more audible, more obvious, and have the potential to be more explosive.
So simply, it's the same advice to everybody who comes into the space. Just buy Bitcoin and dollar cost average. So buy some with your paycheck and hold it and get a feel for it. And everybody I've taken down that journey, at first they do that. You're usually giving them that advice when the market's going up. Then they have the correction. They have to learn, oh my God, it can go down 40% as well. Am I going to lose all my money? They have to go through all of this. But that's the learning curve. And then after a while, they get used to the volatility and they become numb to it. And then you can say, okay, have you listened to podcasts? Have you done research? Have you been on Twitter? Not to listen to trading stuff, but just to understand what is this technology? Because Bitcoin is just a part of the space. It's the digital gold is the store of value. But then people they want to get more speculative in the space. They want to try and make money. So then you start saying, okay, listen, only use the top 3 or 4 projects. No, not yet. Not yet. Because at first, they're coming out of 401k world or investing world, or they've got a bank account and they're getting 5% interest on their deposits, right? The Uber driver. And he's thinking, well, how do I make money? I've owned some, he might have bought a share or two or owns, an ETF. So when you say, well, Bitcoin on average does like 150% returns over since 2012, they're like, holy shit. But then once you start seeing the rest of crypto, you're like 100%, but that bloke just made 100x. Okay, this is the danger zone now. This is when they start, you talk to them and they're like, I'm all in on Fartcoin. You're like, no. And I try and explain to them is you have to go down that learning journey, do that with 10% of your portfolio, because then you can fuck it up. You can drink wine online and insult people. But the other issue is that's not the only risk. This space is so full of risks. You have to be paranoid at all moments. Because before you know it, you're like, well, I'm buying and holding, so I want to get some yield.
Next one I wanted to ask, yeah.
And then you're on some DeFi protocol that's giving you yield and something goes wrong, goes to zero immediately. Okay, that is a classic one that happens endlessly. Or you expose your wallet and get hacked. And people don't understand wallet hygiene and how to keep things in different wallets and never expose your key wallets to things, always have a step in the middle, the custody side of stuff. There's so many ways you can get hacked. There's people impersonating me online or you online, trying to get your wallet, or impersonating Coinbase online. Everybody's after your money. And you have to be paranoid at all points. So you don't need to worry about, will the market go up over time? As long as the central banks keep printing money and this technology gets adopted, you'll be fine as long as you're adhering to not being too far out the risk curve. And then you need to be paranoid about every single other part. Because don't forget, in the end, we go back to the point I made earlier, everybody's life savings is in this. This is the single most important thing for most people in their financial lives. And there are so many ways you fuck it up by getting a little bit greedy. Does the 6% yield actually matter to you? Oh, but it gives me cash flow. But if I'm 6%, you get 6% and there's a percentage chance of losing all of your money, and you don't know what that percentage chance are. Now, that's not the case with all DeFi or anything else, but it's just that people end up doing dumb shit. They've dealt with no yield on gold, but they've never owned a lot of gold because there's no yield. So they do prefer it. And, that's why I think when the ETH ETF has yield, which will come, it'll be more attractive to them. How do you get the Bitcoin ETF? Well, it'll be the same as the safest yield will be this kind of borrowing fees for borrowing it. And if it's run by large institutions, you've got some backstop protection. All ETFs have some sort of yield from borrowing that's often taken by the asset manager. I just don't like it because the capital gains is so big. We're not trying to eke out an extra few percent here. And, even stuff like, and I don't really understand, like Lido, the aggregator for staking, right? It's huge. But what you've got is a yield curve mismatch. So you're able to have short-term access to yield, but really they have to lock it up. So managing that liquidity, and they're smart people, is complicated, and we don't know what can go wrong and when it goes wrong because we've never stress tested it. And that could be a weak point. We've talked about weak points many times. It's like Deribit, who I love, is a weak point because it was 80% of all the option market, or 90%. Now, it looks like they might get bought by Coinbase, which is much better for the market, but we need more options platforms. They need more competition to spread risk.
Have you thought about other weak points?
No, it's the yield enhancement stuff I don't like. And, without naming names, but I just don't like them. And they're all smart people and they're good people and they're all trying their best. But I think those products should be in the hands of professionals and not retail. I really do. Now,
only institution can invest in them, you're saying?
Yeah. To put their capital, because they understand the risks, where are the counterparty risks, all of that stuff. And if they want to get the extra yield from doing that, great. You're Brevin Howard hedge fund and you've got cash and you want to reinvest that, or you've got crypto holdings. That's your job. But for the average person to see 20% yield and that this is amazing, I'm going to be rich, you don't know what risk you're taking.
Scale, infrastructure, and maturity of the cryptocurrency ecosystem are the characteristics that set today's market apart from the one that existed in 2017. During that time period, the meteoric rise of Bitcoin was primarily driven by retail speculation and grassroots enthusiasm. Alternate cryptocurrencies followed suit, and the fluctuation of prices across the board occurred at a dizzying rate. This same energizing momentum is currently gaining momentum once more, but this time with a higher level of sophistication. Bitcoin is receiving billions of dollars through recently approved spot exchange traded funds, ETFs, in the United States, a channel that did not exist during the previous cycle. As a result of the steady decline in exchange reserves and the accumulation of long-term holders at record levels, there is a decrease in the amount of emphasis placed on selling. When it comes to speculation, the market is no longer merely a playground. The narrative surrounding Bitcoin has shifted from one of hype to one of legitimacy, and institutional capital is taking it to the forefront of the conversation. This cycle is being fueled by both macroeconomic forces and deep-pocketed players. as interest rate cuts are currently being discussed and central banks are getting ready to flood economies with fresh capital. According to Pal, this does not appear to be a market that is getting ready to crash. Rather, it appears to be one that is on the verge of experiencing a prolonged expansion.
And I think it's either or. And I don't really know. What I do know is by him doing what he's doing, he's creating leverage in the system. So he's basically, via the convert, selling cheap options. They're being bought by option arbitrageurs, and who are then laying off the option risk on exchange, whether it's against Bitcoin or whether it's against MicroStrategy's listed options themselves. But also, they're trading the NAV versus Bitcoin, which moves around, and that's feeding also within it the perps versus spot, the futures versus spot, all of the arbitrage in the system. And arbitrage uses a lot of leverage because you're making smaller returns and they use leverage to enhance the returns. It seems right now that most of the buyers of the converts are TradFi hedge funds and others. So there's people like Norges Bank, who are a sovereign wealth. They buy it for just the Bitcoin element of it. But then there's a bunch of Citadel and Millennium and Point72 and all these giant hedge funds, and they're doing the arbitrage. These guys understand risk very well, and they're probably systemically backstopped as well. And their position's not big enough to blow them up. It's who else is going to take the risk further out the curve that blows up. This market always blows up from leverage every time.
And we're seeing
there's no such thing as free money.
No, for sure.
And when people start calling it like the free money machine or whatever it is, it's like, no. And so, and the other thing is, there's a lot of ETFs that are attached to MicroStrategy's, the 2x longs, that creates this convexity, but it also on the way down, MicroStrategy falls more. And then it starts trading at a discount to NAV. And then that blows up the arbitrage people. There's easy ways to see as this thing builds and builds and builds, how it can create systemic risk in the system, in the crypto system, and maybe in the finance system. I'm definitely over 70% sweet. And that's not anything to do with the foundation that I'm on. That's my just capital allocation of my savings. And simple, it's not because I'm on the foundation and people are like, hey, he's just shilling his coin. It's because the fucking chart of Solana, Sui versus Solana broke out. And Solana was the strongest horse in the race. So if another large token is outperforming Solana on like weekly charts, daily charts, significant time horizons, and the chart pattern looks good, and you can see the adoption, and it's got a lower free float, and there's large demand, and there's a lot of developer activity, and all of the things we talked about, then I'm forced to do that. I then also looked at anything versus Sui now, because that's now your benchmark.
Yeah.
And then what's funny is you see, well, there's one token that's doing really well versus it. DeepBook. And DeepBook is the liquidity layer Sui, so I own some of that too. You feel throughout, you see the type of projects they're going for. It's interesting because, I get called into a few meetings with some people that they're talking to, and like Christian, who's the head of the foundation, his opening question now to projects that want to work with Sui is like, well, show me the path to 1 billion users. Right? Because it's built for that scale. And if you're leading with questions like that, is like, yeah, okay, it's interesting you building this, whatever, but is this going to bring me 1 billion users? If it's not of high priority. And so their mindset is really big. And they back it up by, all of the projects that they've been launching. So, I've been privileged to be on the foundation to see the inner workings of an amazing group of people and see how they all come together. They're basically all ex-Facebook and Google. And they're very smart. They understand scale. They understand how to solve really difficult things, Walrus, stuff like that. It's super interesting. And so I think the market's picking up that narrative. Now, it's very early stage, It's going to have to go through a bear market. It'll go down a lot because low free float goes down a lot, like it goes up a lot. And then you need to see how well does the team manage a bear market. Do they have cash? Are they investing? Are they building? Which is what Solana did really well last cycle. Tolly did a magnificent job of doing that under extreme pressure. And that's when Lindy effects kick in. Tolly earns his stripes from that. And so it's still early, but, it's got all of the hallmarks of a massively growing ecosystem, massive growing number of users, massive growing number of applications. Have they had the big breakout application yet? No. But there will be one this cycle, and that'll be the first start of the bigger narrative.
The optimistic outlook for the market is rapidly gaining traction, and analysts are revising their forecasts in accordance with this. Jeffrey Kendrick, a prominent voice in the industry that is employed by Standard Chartered, has recently projected that the value of Bitcoin will reach $120,000 during the current quarter and may even reach $200,000 by the end of the year, 2025. A number of factors, including rising bond yields, continued accumulation by whales, and aggressive inflows into cryptocurrency funds, are supporting this bullish outlook. In the span of just 1 week, cryptocurrency investment products have garnered more than $3.4 billion, with Bitcoin being the recipient of the majority of this amount. Retail enthusiasm is not the only factor contributing to the momentum. There is a discernible and growing shift in capital away from traditional assets held in the United States and toward decentralized digital stores of value, such as Bitcoin. Further bolstering confidence, President Trump's recent signals toward easing trade tariffs have begun to ease fears regarding the global economy, which has supported a wider appetite for risk. Bitcoin's trajectory toward new all-time highs appears to be increasingly supported by both fundamentals and sentiment as liquidity continues to build and institutional demand continues to grow. Under these circumstances, analysts caution that underestimating the potential of Bitcoin could be the most expensive mistake an investor could make.